Good morning, afternoon or evening, ladies and gentlemen, Allincrypto here, and welcome back, guys, for what is going to be nothing short of another jam-packed daily market update. It is Saturday, so you know what that means. We are taking the day out of the office, so we're coming to you live from at home, or at least pre-recorded from at home. This video, or this daily market update, is coming off the back end of a pretty significant week in regards to the markets. We had earlier in the week the likes of servicing PMIs come out, and it was the best print for servicing PMIs, which really is a barometer for how well the economy is doing, in over a year. Now, this is important. This is, we've seen a lot of dollar strength. Interesting that actually yesterday on the back end of non-farm payroll, we saw dollar strength, but we actually saw asset strength as well, and we'll talk about why that is. But towards the start of the week, we had PMIs. Servicing PMIs came out. I think it was 54 point something, and the expectations were 51. Massive beat. Shows are really, or at least the statistics, whether you choose to believe them or not, is up to you guys. And also, you've got to factor in, I think more importantly than anything, the fact that those stats are what policy decision is made on. So it's kind of like looking at inflation and looking at CPI and true inflation. Okay, true inflation might say one thing, but the Fed don't use true inflation. They use the CPI stats. So you take them for what they are, whether they're manipulated or not. But we saw PMIs come in, very positive. It kind of quashes this notion of a recession. And we've very much been in the camp of it's a non-recessionary easing environment that we're going into, where we see global liquidity increase. And actually, we looked at that study from Lynn Alden, I think last week, it could have been Sunday or Saturday, where we were at home again, where we showed that actually Bitcoin is the most correlated to global liquidity, and markets generally are positioned to do well across the board, whether you look at that fundamentally in regards to what we think is going to happen with central banks, what they're going to do in regards to easing, which is going to increase money creation, which ultimately is going to increase global liquidity. It's going to see all these cycles play out. And in order for our thesis to take place, we need to not go into recession or depression or whatever may be waiting for us. And we don't think that we are. And actually, this week that we just had, we saw a lot of confirmation in regards to that. Of course, PMIs. We also had ADPs, which came out above expectations. And then, of course, yesterday, which is where we're going to be starting the video off, we saw non-farm payroll number come in. And non-farm payroll numbers expectations were, I think it was 147,000, and the print that we got was 254,000. So over 100,000 more than expectation. The unemployment rate also dropped, and you could guess, or you can guess, what the headlines were on the back end of this. US job creation roared higher in September as payroll surged by 254,000. Non-farm payroll surged by 254,000 in September, up from the revised 159,000 in August, and better than the 150,000 Dow Jones consensus forecast. The unemployment rate fell to 4.1, down 0.1 percent points, as the survey of household employment showed an even stronger picture with a gain of 430,000. Average hourly earnings increased by 0.4% on the month, and we're up 4% from a year ago. Both figures were ahead of respective estimates. So this is what this is all about. And in order for our thesis, and we do think it's going to play out because of technically what we're seeing, in order for our thesis to play out on the markets, we need to not go into recession. And we don't think there's any cause for concern. Yes, we have seen an uptick in unemployment. And let's show you that chart and why the concern is there. This is, of course, unemployment. And this is unemployment with the S&P overlaid. And you can see the correlation here is unemployment at a high in black, markets at a low. Unemployment at a low, markets at a high. And you can see that the worry here was when we start to see this sort of surge up in unemployment, it leads to sort of the beginning of the end. And there's lots of skewed data on the back end as, of course, March 2020 and the fact that we all went into lockdowns and what's an economy going to look like after that? Well, you can kind of expect things to be skewed. Also, in regards to unemployment, you've got a hell of a lot of immigration taking place, often illegal in the likes of the US and the UK right now. And that's going to skew data even more so in regards to these stats. And we quite simply think, and you're always in danger of saying that this time is different in regards to what we're seeing in unemployment, And actually, unemployment isn't going to resurge, just like we didn't think that inflation was going to resurge in that 1970s fashion that many people said out there. And this week has been all about kind of, I guess, squashing the fears of a recession to more of a degree, which were, of course, put into the room in regards to unemployment. You, of course, saw the dollar be strong on the back end of this because it essentially means that in regards to unemployment, the Fed doesn't have to cut as aggressively as some people may have thought. And that's what's really going on here. There's a constant repricing of rate cut expectations because ultimately they're bullish for the markets. Certainly, historically, that's true. There's an idiosyncrasy out there that we continue to combat in regards to this notion that people think when the Fed cut rates, that's bearish for the markets. If you look at the past 14 times the Fed have cut rates, the return of the S&P 12 months later, only 2 of those times has been negative. The other 12 times has been pretty spectacular or pretty good on average. And those 2 times, of course, were the 2008 financial crisis on the back end of the mortgage-backed security blow-up, and, of course, the dot-com and telecom crash in the 2000s. Context is very, very important. But we've seen that strong dollar coming in because people aren't... The dollar is still on a downward trajectory. They're still going to cut rates. The dollar perhaps just gaining a bit of strength because there's now that repricing of that. And the interesting thing was assets actually closed rather well yesterday. We've got those higher targets for the S&P. It's interesting because we looked at a number of small targets, didn't we, in regards to short-term patterns that we're going to see upside. And we've said, look, this gives us our opinion that the Iran-Israel conflict isn't going to escalate. And remember, if you look at those big cycles, global liquidity, PMIs, business cycles, election cycles, Bitcoin 4-year cycle, they're all predicting upside, or at least an environment where assets do really well. We think you've got every reason to expect that technically, fundamentally, and every which way. And actually, this week was huge in regards to economic data that we got. Really kind of, squashing, some of those fears in regards to a recession. We'll come back to the markets in a little bit more detail once I've finished what else we have to get through. So to wrap up that segment, crucial week in regards to economic data. We got good data, basically, and it kind of pushes down that. And there was an article actually from CNBC that I want to go over to, which is this one. It says, Fed close to pulling off the elusive economic soft landing in 2024 after a great September jobs report. We thought this was actually quite plausible. In fact, we don't even think there's going to be a landing necessarily. And there is, and I'm probably going to see if I can get the individual on who's got this thesis of, can we ever go into a recession given how monetary policy now works? And on the back end of that, I want to dive over to this tweet here. This is from an individual, probably not even going to attempt to read it out, but you can see it there on the screen. Breaking, US debt has jumped $345 billion over the last 3 days, hitting another record of 35.7 trillion. So think about 345 billion. I want to put that into perspective for you guys, right? I believe that the 2008 financial crisis was about 500 billion in terms of bailouts. There's no financial crisis. We've just done that in 3 days in the US. I say I'm in the UK. I was going to say fortunately, but actually I don't think there's anything particularly to be that fortunate about given what we're currently going through here with politics and all this sort of stuff. Let's maybe leave that one there. But that really puts things in context, doesn't it? And this is the reason I'm highlighting this is because this is the great game. This is why you should be an investor and you should get out whilst you can of the fiat systems. In a smart manner, you need fiat. It's how we transact and whatnot. But if you want to... Saving in cash just doesn't make any sense. It doesn't make sense for this reason entirely. And this is the whole reason why Bitcoin was created. It's the whole reason why assets do well. When we say the yen or the Nikkei is a short yen trade, when we had that readjustment of interest rates for the Japanese yen, it really showed us the effects of central banks manipulating currency and thus the markets. We've got the adverse of that happening with larger central banks, and we think that's going to see the markets do well. But this is the great game. Since June 2023, federal debt has surged by a massive $4 trillion, over 14%. Since 2023. It's only 2024, guys. Over the same period, US GDP is up 1.5 trillion, over 6%. In other words, the national debt has outpaced the economic growth by 2.5 times over the last 16 months. Outside of the pandemic crisis, US federal debt has never grown so much, so rapidly. What is happening here? Well, I think it's very simple. It's like a snowball rolling down a hill. It picks up more snow the bigger the mass, the more snow it essentially attracts. And that's what you've got. You've got this sort of spiraling with the debt systems that is being compounded by the interest that's on them. You know, the heat is really on the Fed also to lower interest rates. And at what point at this stage does QT become QE? What point does high interest rates in the name of sort of restricting money creation and this sort of stuff actually become QE, in the sense that you're going to need to print money essentially because you're not earning it to actually sustain the burden that you've put on the colossal debt out there. And money is debt. All money is an IOU. That's how it comes into creation. So if debt's getting devalued through adding, that means money itself is. And this is why you should be in assets of some form or another. Of course, this is the US national debt clock. We spoke a lot about sort of macroeconomic stuff, but it's very relevant to the picture that we're painting. Ultimately, when we look at Bitcoin, you know, it's a pretty picture that we have, in our opinion. It's a very pretty picture, whether it's technically, whether it's fundamentally. We don't talk enough about just how much of a transformative sort of technology distributed ledgers truly are. They're fundamentally going to impact many industries out there. Money is just one, perhaps, large use case for it. But we've got lots of technical confidence in regards to the direction we think Bitcoin is heading in. We did have that smaller pattern that we looked at. Yesterday, I did a video on, it was actually 12 altcoins, where I showed you that we've got the same pattern for all of these on the shorter time frames, and they're really going to start to get rocking and rolling. This is going to coincide with Bitcoin rearing its head, those small patterns on the sort of markets taking place. Algo, HBAR, ADA, Filecoin, Doge, Akash, Shiba, Near, Jasmy, Render, Sushi, Arweave, etc., Uni, all showing the same pattern that we ultimately is going to believe to upside. We're seeing lots of positive things. We had small-term targets on Nvidia, the SPY, the US 100. This leads us to believe the Israel conflict isn't going to escalate, because if the markets aren't particularly going to go up on the back end of that, maybe you could argue Bitcoin might. But generally, we don't think that the markets would be going up if there was some sort of escalation in regards to war. But there's lots of reasons to be bullish. Of course, the dollar being strong is typically bearish. We're wanting that dollar weakness to see sort of markets play out in the manner that we think they're going to. I do think that's going to come. I think you've just had a bit of a pullback move for the dollar on the back end of really strong data and perhaps a repricing. You know, it could come all the way up here, retest this pattern that you broke out of, and then still find its way to the downside. But the dollar is on a downward trajectory, and we think that's very much signalled. Great, we just moved our target there. By sort of the direction that rates are going in. In regards to a little bit of on-chain news, this is interesting. BTC balance old whales versus the new ones. Whales are accumulating at a pace never seen before. So are institutions, by the way. If you look at the amount of sort of Bitcoin that's been held in institutions, it's interesting because during this kind of pullback phase for Bitcoin, we're seeing accumulation from typically larger money. We're seeing distraught from retail. It's been an interesting week, but ultimately you want to ignore that, and this is why we like to put on the armor of technical analysis, because it ultimately helps us predict to more of a degree of accuracy what way we think the markets are going than just following news headlines. Some interesting news in regards to Coinbase. So Coinbase very recently just announced that they're going to be sort of delisting the likes of USDT and others that don't apply with MiCA regulations within the EU. We ultimately, the interesting with this is what we think is going to happen with USDT DOM. We didn't know this was going to be the case in terms of regulations, but we've got a target. USDT DOM, in terms of the overall market, currently sits at 5.6%. I think it could be coming down to 1.3. I think that's going to have regulations to do with it. I think you're going to see the rise of real USD, etc., etc., etc. So we've covered quite a lot. The important thing to sort of take away, I think, from last week generally was the good data that we saw. We saw great data in regards to the economy. It shows that there's no recession. We don't want a recession for assets to do well. Ultimately, the beautiful thing about the thesis that we've laid out in regards to what we think is going to happen with assets is we continue to get confirmation of it being likely to take place. Whether that be sort of not seeing that doom and gloom scenario, the kind of bear case playing out, and the reasons to believe a bear case would play out, you know, we keep getting confirmation of that, and we continue to get technical confirmation in regards to progression towards the direction that we think things are going. Fundamental progression and every which other way. You know, this next year, I truly believe is going to change people's lives. If you want to find out what I'm buying, you know, we've got stocks in there. We've got literally 100x cryptos from where they currently are. We've got one big one that we're kind of keeping under wraps and reserving for the Patreons. Do consider becoming a Patreon. Guys, on that note, I'm going to love and leave you. Have a smashing Saturday. And I'll see you all in the next one. Thanks for watching, guys. See you in the next.